formal intro. There may be the odd person who's joining us a little late, but that's all good. So hello everybody, welcome to this week's Virtual Mentor Office Hours. Thank you for getting here a little bit earlier than usual. We really appreciate it. Tonight we are joined by two very special guests. They are internationally trained accountants and they both work for BDO Canada LLP in their Vancouver office. And tonight Patricia and Sarah are going to be sharing the fundamentals of financial statements for lawyers. So basically the basics, to give us kind of an overview of what they are, how to kind of interpret them for various different things, and maybe even work out some calculations. Yeah, I know, shock, horror, lawyers actually have to do maths. I know it's very scary. If you're wondering why on earth we're doing this session, it's because it doesn't matter what practice area you end up working in, you're going to end up looking at a financial statement at some point in your career, whether it's for your own practice or whether it's because you're looking at it in terms of a client. So you're preparing costs, you're doing a M&A transaction. Doesn't really matter what it is, you're going to end up looking at them. So I'm going to basically hand over to the ladies. I'm going to let them introduce themselves, give a little bit of a background, a little bit of a flavor for their journey so far, and then let them go into their presentation. But one little housekeeping thing for you, we're going to keep everybody on mute tonight until we get to the question and answer session. Talking of question and answers, both Patricia and Sarah have both said they're happy to try and answer as many questions as they can possibly fit into our session. But in order to manage that process, we're going to ask you to put them into the chat box down below. And then we're going to try and like sprinkle them in at the correct point throughout the presentation so we can keep the session flowing and we don't get stalled on one part. So please do ask your questions. They're very open to trying to answer them or to point you in the right direction to answer them. And we're really looking forward to this session. So Patricia and Sarah, thank you so much for joining us. I'm going to hand it over to you.
All right, thanks. Well, welcome everyone. And just to add to what Siobhan just said in regards to the questions, if there are any questions we're not getting to today, then please just send them to Siobhan and then she can kind of collect them and then send them over to us. So even outside of the session, we're happy to answer some questions. You know, we understand, you know, this is obviously only a certain amount of hours we have tonight. So if there are any additional questions that we don't get answered tonight, then don't worry, we'll get to them in a written form, or we can always set up some calls if there are any questions you really, you know, didn't understand or anything like that. And yeah, then we'll get to it. Sarah, you can make a start.
Okay, well, for those of you, all of you who don't know me, I'm Sarah Vettoretti and I am Kiwi. So I'm from New Zealand. That's where I started my accounting career and I grew up there. So I was working for BDO for quite a few years in New Zealand, is where I did my CPA or CA in New Zealand. I, from there, moved to Australia. I did a short stint in financial accounting and then I moved in Victoria, in Melbourne, and then I moved to Sydney. So and that's where I started off my audit career. And so I was working in Australia for 2.5 years. It was, New Zealand and Australia are very similar in culture, so it wasn't too hard of a transition to get there. It was very, you know, the accounting standards were the same and the people were very familiar, so it wasn't too hard. I felt like I needed more of a challenge to mix it up, so I then came to Canada. And while everyone still speaks English, it's a bit different over here. You know, you're not used to the kind of society and just how people are, and so that was quite different. And also, we will be going through it later on, but there are different accounting standards here that we don't have. So it was also quite a learning curve, having to pick up, I think, 3 new accounting frameworks when I got here. So it was quite big. So I'm lucky enough to have been here maybe 1.5 years, almost 2 years now. So I feel like I've got a bit of a handle on things, but it was but it was really challenging at the start. So to understand where you guys are. Yeah, so I'll just pass over to Patricia.
Yeah, so I've taken a bit of a different route. Whilst we've lived in equally many countries, other than Canada, there isn't much of an overlap. So I'm born and raised in Germany, so went to school there, went to university there. After my master's, transferred over to the UK to start my chartered accountant, and then worked there for almost 6 years. Sort of on and off in the beginning, whilst I was still doing my master's, I sort of flew back and forth between the UK and Germany to really get some work experience in. And then from 2015, permanently moved there. And then in 2019, my partner and I made the decision that it'd be time for a change, leave busy London, and come to sort of a more outdoorsy, work-life balance, friendly country, and then specifically chose Vancouver just for our love of skiing and sailing and all of that. So then transferred over my ACA to the CPA over here, and the two of us are actually taking an exam in November, whilst we already are allowed to call ourselves CPAs. To sort of keep that title for life, we have to do a conversion exam. So we're also licensed out here in case we do want to sign auditors' reports one day. So yeah, we're doing that in November. So for all of you studying at the moment, even though, you know, we've all thought we've been there, done that, no, we got to go back to that now. So sort of that's the perks with having to change the country. And then, yeah, I've been here since September last year, so just over a year. And BDO is a great firm to work for. It's very international. There's a lot of different nations and cultures around. So we've got some people from South Africa, some people from the UK as well. We've got Kiwi. It's a bunch of a mix. Some people from India. It's, yeah, a huge variety, which is great. And I think with further ado, we'll get into our slides now. So yeah, again, as we said earlier, in case you have any questions, just shoot them to Siobhan and then we'll try and answer them all at the end. Now I just have to figure out the the wonders of technology. I'm sharing this. Does that work? Can everyone see that? Hopefully. Yes, thumbs up. Can we see that?
Great.
And are your pictures in the way, or can you see the whole screen? All good. Okay, perfect. All right. So we've created this session to sort of give you a bit of an overview. We'll give you a bit of an overview of, you know, what the firm does, if there are any other areas. You know, there isn't just audit. Whilst we love audit, there are other, every accounting firm usually has other departments within it, but we'll get to that in a minute. So we'll tell you a little bit about that. Then we'll give you an overview of sort of what types of entities are out there, the different frameworks. Sarah already mentioned that word earlier. So just in regards to, you know, different countries and depending on, someone's not on mute. Sorry. So different frameworks, so that might depend on the type of entity, that might depend on the type of country, the type of industry that a firm is in, so different frameworks there. And then we'll talk about the relevant individuals that are sort of involved in the whole process of creating financial statements, and, you know, how the information gets from, you know, a little transaction on one side to being a set of financial statements on the other end, and all the steps in between. Then we'll talk a little bit about the basic accounting principles, different ways of recognizing certain items. Then we'll really dig into some financial statements, show you an example. So, you know, the first time you're going to see all that page with all those horrible numbers on it, you roughly know what you're looking at. You know, there are a few different types of statements. So, you know, the title is going to give you an indication, and we'll jump into that a little bit. And then one of the questions that we've also already been sent in advance from Siobhan in regards to some key financial ratios. So once you do understand a little bit what you've got in front of you, We just want to help you to be able to work with those numbers, you know, maybe do some calculations, compare one year to the other year to see whether there's been a change in performance, whether the company is overall doing better or worse in comparison to the previous year, or maybe between two different sets of financial statements. And we've sort of just, you know, there are a million ratios you can calculate out there, so we've kept it to a reasonable amount. But if afterwards, again, there are some more ratios you'd like to know about, maybe we don't know them all off the top of our heads, but we can certainly do that in an email chain afterwards to sort of, you know, comprise a few more of those ratios. And then, yeah, we'll get to the end where you can then ask questions, and we'll hopefully be able to answer as many of them as possible. Sometimes it's great to do those sessions with people that don't usually deal with numbers, because it's a different way of thinking, and you know, it's a type of thinking outside the box, and maybe things that seem very clear to us that we would never think about would occur to someone else, and sometimes that just gives you a different perspective. And so yeah, we're really excited about, you know, hearing all your thoughts and questions. And yeah, then I'll dive straight in. You've already learned a little bit about ourselves. You'll get the slides anyway, so you'll have our email addresses, and you can always find us on LinkedIn. If you do want to contact us for any reason, please do so. Siobhan's probably thinking, don't say that, because you're going to regret that. You're going to get a million emails. No, please do contact us at any time, and hopefully we'll be able to help. All right. So BDO is a very international organization. So basically any country where there is some sort of trade, you can imagine BDO will be there. We are worldwide the 5th largest accounting firm. So you've got the big four, you know, everyone's heard of PwC and Ernst & Young and, you know, Deloitte. And then after that big block, there's straight away us, little gap depending on what country you're in. Sometimes the gap is very small, sometimes it's a little bit bigger. We've got all across Canada 125 offices, so in most major cities. And I mean, even in the greater Vancouver area, we've got an office, for example, in Langley. So, you know, sometimes it's not just the major cities, it's also surrounding areas. We've got revenue of around about 650 million Canadian dollars a year across the country. And then I already mentioned earlier, we don't just offer audit service. Whilst in most of these offices, the audit practice will be the biggest one. Just because, you know, there is a requirement, not necessarily a statutory requirement, which means that a company has to have an audit done, but a lot of companies need an audit because, for example, they want to get a bank loan, and the bank says, well, the only way you can get a bank loan is if you show us some audited financial statements, because we're going to want to get some assurance that, you know, your numbers aren't just made up. And that's why there is generally a quite huge requirement. So the audit practice is usually one of the biggest ones in each office. And then we offer some other services, financial advisory services that can be anything from due diligence, for example. You know, one company wants to buy another company. Before they buy that company, they want us to look into the details and just give them a rough idea of, you know, what's going on, whether it's a good deal, what kind of price to expect when wanting to purchase that company, and so on. It can be any sort of consulting services in regards to, let's say, for example, risk advisory. If you go into a company and they use controls within that company and you want to see how well they work, we can come in and we can look at those controls to see, you know, for example, let's say they have very high valuable items and they should be stored in a safe. We can go in to check, you know, are there enough steps in place to ensure these items are safe, just to give you a basic example. And then, you know, any types of valuations, let's say a company is struggling with their money, we can do debt restructuring. We do legal advice as well, probably not as, you know, specialized as a pure legal firm. It's sort of more on a smaller scale usually. Yeah, and then one of the other services which is quite special to accounting services, I don't know if that also exists in law firms, but for example, we can lend staff to other organizations. let's say they need a CFO, but they don't want to hire a new CFO on a permanent basis. They just need someone to bridge them over for 3 months. Then, you know, one of our partners or one of our senior managers could go in and perform that role. So, for example, at the beginning of this year, end of last year, I spent 3 months at C-SPAN in the financial reporting department, because they were short a manager. So they just needed someone to help out to get their financial statements in order. And so they basically hired me off BDO to just come in for 3 months, help out, and then I would jump back into my role afterwards. All right, and then we'll jump into some entities and frameworks.
Okay, yeah, so I've just put a little summary here of the types of entities you might come across, and they'll all be structured slightly differently when you look at their financial statements, and a lot of them will also report under different accounting frameworks. So they will, for example, a sole practitioner or a partnership or limited partnership will generally be using quite simplified financial statements. I mean, you guys probably know the structures, like whether the liability is limited, unlimited, etc., maybe better than we do, but they all have their different levels of, you know, liability, and they all do reporting slightly differently. So a lot of the, yeah, there was kind of, I think that's probably okay on that slide. Yeah, I guess, yeah, but I think so. There are really 3 main bases of accounting. So one that you're probably familiar with, that you use when you're looking at your own own kind of money, is the cash basis, right? You pay for something, your money goes out, you never see it again. Some business has has put it in their books, and it's revenue to them. So, and that's like, cash basis is sort of the concept of recording when the money changes hands. So when you pay for something or when you receive. So when you receive your pay, that's you might have already worked 2 weeks, but you're receiving it at the end. That's when you receive it, you record it. That's the cash basis. So the tax basis is very kind of specialized. It's more used by tax if they're just preparing something solely for a tax return, not really kind of too worried about the accounting presentation. They have a lot of specialized rules, which, well, I'm currently learning about the Canadian tax rules, but that's not my specialty. And so, yeah, we won't go too much into that, but the accrual basis is the type of accounting basis where that most financial statements are based around. So it's the concept of if a transaction, so it's kind of recording something when a transaction happens as opposed to when the cash changes hands. So for example, using, say, a salary, you have earned your salary over the past 2 weeks, and then at the end of that, you might get your pay at the end of the 3rd week. So there might be a week gap. When you get your money, that's when you would record it under the cash basis. Under the accrual basis, you would record your money, your revenue, as it's earned. So at the end of your 2 weeks, on that Friday, you would record your 2 weeks worth of revenue, and so it would kind of, it doesn't align with the cash movement so much as the nature of the transaction. So for example, if you ordered a piece of equipment, is when you order it is when you would record it, not necessarily when you pay for it. So it's that kind of concept. I don't know if that is super clear, but if you have any questions on that, then yeah. Okay, so I just going to kind of walk you through the general frameworks that we deal with. So I mentioned them earlier, and if you don't know what framework means, then that's completely fine, but it would be equivalent to like a standard. Yeah, like a standard, or like your own version of the law, right? So you've all come from different countries, and you know, in Canada and like European countries, they'll use more of like the English law, whereas other countries may not. It's a different kind of framework. I don't know, that kind of thing. Yeah, so the first one I'm going to talk about is International Financial Reporting Standards. So you might see it commonly referred to as IFRS or IFRS. People say it differently, but essentially that's the basis for the frameworks that we used in New Zealand and Australia. They also use it here, and it's very international. So the accounting standards are the same, whichever country you're in. It's used a lot for listed entities so that their information is comparable. So you're trying to buy shares in a company, you know exactly what those financial statements are telling you, rather than trying to deal with countries who have different interests and priorities. A lot of that's with listed companies, and a lot of public sector or government organizations will have like sort of for-profit entities on the side, and that is legislated that they have to use international financial reporting standards for those entities as well. And I guess any entity has the option to use these standards, like any private entity or any sole trader, but the standards are a lot more onerous, so it's more expensive if you prepare your accounts that way, and it's generally not necessary in Canada. So
yeah, so they basically just require a lot more disclosure. So you know, when you usually under a more simple standard, your whole set of financial statements would only be 7 pages long. You can expect it to be, you know, almost double as long if you prepare it under this standard, just because there is a lot more detail required to describe your different transactions. And that's why a lot of companies, unless they have to, wouldn't choose this.
So this one is accounting standards for private enterprises. This is probably, I would say, unless you're working with the really large companies, it's probably the most common one that you'd see in Canada. I'm not sure, Siobhan, if you can speak to that. I'm not sure what you see, but it's, you know, if you're doing, you know, state law, like things like that, like people will generally be preparing their financial statements under ASPE. So this is, it follows accrual accounting, as I just described to you earlier, and it's very kind of, I don't want to say simplified, but it has rules, but they're not so strict. They allow for a bit more interpretation and a bit more judgment on transactions. So it's, yeah, and as Patricia was saying earlier, there's a lot less disclosure. So it's not, yeah, it's, once you've seen a few financial statements, that's probably something that you'll understand a bit more, but it's, yeah, as Patricia said, the financial statements are generally shorter and they're easier for kind of anyone off the street to understand. You don't need kind of the level of familiarity with them that you would find. Is that if we were doing accounting and there was something that there was no guidance for, you would refer back to IFRS as sort of the overarching kind of global standard. So there is guidance there that you can use. Yeah. Okay, and so another one that is specific, to Canada as well, and specific even further to not-for-profit organisations, is accounting standards for not-for-profit organisations.
It's been really, really inventive with the names there.
It is very similar to ASPE, and it's more of an add-on. So there are specific transactions or things that not-for-profits deal with that wouldn't be covered under under a standard business. So there are different accounting standards to help everyone kind of account for those. Yeah, if there's a lack of guidance in those standards, we will also just refer back to sort of the next most detailed standard that would give you the help you need. There are a couple of other ones. So there's accounting standards specific to pension plans, which is, it's just specific accounting to those, and we won't go into too much detail on that. Something else that you might see, since we're all living in North America now, is the US GAAP. So what US GAAP is the accounting framework that they use in the US. So Some listed organizations will use it, and the majority of large businesses headquartered in the US will also use it. As the notes say, it's very similar to IFRS, and just as a global movement now, and the accounting standards boards of all the countries are trying to make the standards more streamlined. So if you're reading a set of financial statements in Canada, or you're reading a set of financial statements in the US, or England, hopefully they will all tell you the same thing, and so they'll be much more comparable. And so over time, the US GAAP standards are changing to be more in line with IFRS.
Some point we all so she hopes.
Yeah.
All right. Well, I'm going to move on to talk about the individuals that are involved in creating these financial statements. I'm going to sort of, in a pyramid form, start at the top with the big boss, and then work my way down to coming to the smaller people. So right at the top of most organizations, the guy that's in charge of the finance department is the CFO, so the Chief Financial Officer. However, depending on the size of the organization, that might not be available. Then the next, lower level, being the finance director or something, might only be sort of the top level in an organization. A CFO will usually not deal with any of those day-to-day transactions. He's too important running around having meetings. So if we, go into an organization to do our audit, for example, we'll rarely deal with the CFO. He'll be the one at the end of the day signing documents to confirm that something is the way it is, but we'll rarely deal with him, on a verbal basis on a day-to-day. So obviously he has the highest level of authority in a company, and he will be signing on behalf of the company, but he's not going to be liaising with his finance team daily. So only when there's big things to report, to now move on to the next level, the financial controller or the finance director, that's the person who will be communicating to the CFO within the company to pass on if there are large major items that he can't make a decision on and he needs the CFO's input. So the finance director and controller will be, again, overseeing on a high level. He's a little bit more involved than the CFO, but he's still not going to be approving daily transactions or anything like that. So let's say, there is a company, they want to buy a subsidiary, then he'll probably get involved to, do some dealings in regards to that, but he's not going to be the guy that, types the numbers into the computer and looks at those on a daily basis. All right, so then we'll move on to the finance manager. So that's, again, the next level down in terms of hierarchy. So the finance manager is involved in the day-to-day business. So this is the kind of role that I used to do at C-SPAN at the beginning of the year. So you would oversee your finance team, which is made out of sort of anything from junior to senior accountants. You'll approve any journal entries they've made, any transactions that have happened, generally review any work that they're performing, and then communicate sort of any major items up to the next level, which will then be the controller or the director. And then we'll get to the busy bees, the finance accountants and analysts. Those are the people that really work hard on a daily basis. They need to, make sure, put together all the documents and make sure that all the transactions are in order, and, enter any, let's say they buy something, the company's purchased something, so they've got an invoice, a piece of paper lying in front of them, and then they will type those numbers into the computer before the manager then looks at it to make sure everything's been entered correctly. Yeah, and then some companies, again, it could be a specialized company, it could be a particularly large company, would have some different departments that specifically only deal with one type of transaction. So all of us get paid at the end of the day. So I hope so. So basically there'll be a payroll department, and they will be dealing specifically only with the payroll. So their job every single month or every 2 weeks in Canada mostly will be dealing with getting, all the information together. How long has everyone worked? type that into the computer, and you know, then it'll go through the approval chain. So they'll basically have their own finance manager within that department, maybe a director as well, and you know, that'll be within those smaller departments. All right. Okay, so one of the things that we thought would be important to talk about as well, just in case it comes in up in conversation for you, and to understand, you know, how the information gets onto the financial statements in the first place. So we've spoken about the people now that are involved, but then there's also a lot of software and, you know, potentially Excel, depending on like a smaller company might not have any software other than Excel, so they might not have anything specialized. So those numbers need to somehow get together in the first place. So a lot of the sort of more commonly used softwares are, for example, something called Xero or SAP or QuickBooks, which is basically a system in which you can enter those numbers rather than having to put them into Excel. And to give you a simple example, so for example, my partner doesn't know anything about accounting. So when I talk to him about accounting, he looks at me like I'm speaking a different language. So these systems are so smart that you, for example, only say, oh, I've received money, you know, $500, and this was my revenue. And then the system knows what to put onto the other side. Or, you know, it'll know, you say, oh, I've received $500 in cash, and then it'll know, oh, okay, so that means that was revenue. So these systems are quite helpful in terms of if you don't know accounting very well, you don't have to think about, you know, any debits and credits and all these horrible things, which we'll get to in a little while. No, the system will know that for you, and it will just help. And then obviously in the bigger an organization gets, the larger the amount of transactions. So if anyone would have to keep an eye on that rather than the system doing that, you'd be pretty busy and you wouldn't be able to keep up, basically. And then, for example, there are some specialized software. So imagine you going onto booking.com, booking yourself a hotel room for the weekend up in Whistler. Then booking.com sends a message to the hotel, and the hotel will have a specialized software that takes in the booking, recognizes the dates on which the booking is booked for, so can block that out in the calendar. It'll recognize the amount and do all of that stuff for you. When we now take all of those transactions, they go into one big document. So you can pull reports, is what we call them, from these softwares. And they go into something called a general ledger, which is basically just a big book containing every single transaction that has happened throughout the year. So that's what we then work with, the general ledger. So depending on the size of the company, again, the bigger the company, the longer that report. It can be hundreds, thousands of pages. And then, you know, the backup for how that information got into the system will be a contract, will be an invoice, will be, you know, potentially emails. I've worked with some companies where unfortunately there isn't always an invoice, and you have to deal with the fact that someone just somehow agreed something via an email, rather than there, you know, being a nice contract in place that states this is when it starts, this is where it ends, this is what you will earn throughout that time. And that's how that information basically gets entered into the system, and that's also the kind of documents we would use to verify that information. But we'll get to that later. I know you can't wait to hear about the life of an auditor. All right, so I already mentioned the word journal entries, so double entry accounting. Some of you might have heard it, some of you might have immediately thought I never want to hear about that, and that's fine, I get it. So whilst you thrive on reading contracts, we thrive on looking at journal entries. So there's always two sides to an entry. So like I said, for example, earlier, when my partner, you know, receives his cash for doing his business, he'll have one side entry, which is the cash, and then he'll have the other side entry, which is the revenue that he earned. But we'll use a more simple example in a little while when I explain and talk you through one of those journal entries. Because there are always two sides to this entry, basically one plus and one minus, as logic prevails, that means if you add them all up, they should come to 0. If they don't, something's missing. Because every single journal entry, 1 plus, 1 minus, equaling 0, it has to be of the exact same amount. If it's not, then you haven't recorded something. And those are then also those transactions that go all into this lovely general ledger that I've just spoken about. All right, so I'll give you a very simple example, hopefully, to try and understand this. So let's say a company wants to buy a new piece of machinery. And you know that piece of equipment costs 2 million, and they're going to pay for it in cash. So we're going to leave any accounting basis or anything like that out there. What we're just looking at is how do we record this transaction. So they're going to have to pay money, right? So they have one account sitting here, which is called the cash account. So now the 2 million wander out of that account and go to whomever supplies us with this machine. So I have a minus 2 million. So minus usually means, but don't take my word for it because there are exceptions to this rule, but minus usually means this is a credit. So we're now looking for the plus, which is the debit. We're getting a machine from that guy, right? So the machine comes to us. So yay, we now have a machine that's worth 2 million. So I have my minus 2 million for the money that's walking out of my account. And then I have the plus 2 million for the machine that's walking into my, into my little pool of things that I own. So therefore, plus and minus 2 million overall, we're back to square one because yes, we've now got this fancy new machine, which is worth 2 million, but we also had to pay 2 million. So unfortunately, hasn't really brought us any further, but that's basically how a journal entry works. Now you ask, but how does a company then ever make money? But we'll get to that. All right, so I think that's enough in regards to journal entries. I don't want to impose any more of that on you. Just a very simple example. So we're now hopping to an audit, and where we come into place to make sure that that machine really got to where it was and the money really went to where it was supposed to go.
Okay, so both Patricia and I are managers in audit at BDO. So what we do is after all of those journal entries have been posted by the accounting staff, we come in to check whether they're, that they're right, essentially. So the main, I suppose, thing to note is that if you're speaking to auditors, we review the financial statements, financial information provided to us. We usually don't prepare it. So yeah, so when you're speaking to us, it's not sort of, the responsibility of financial statements is management's responsibility. So we're just checking that the information they gave us is right. We'll normally send, not at the moment because of COVID, but normally we will send a team of say 2 or 3, depending on the size of the business, it can be up to 7 or 8 staff out to the client site. And then from there, we will, look at their transactions, perform a variety of tests on their work. And, for example, we'll get a list of expenses and we'll have to check that they do exist. So we'll pick one and say to the accounts payable or the financial accountant and say, hey, can you show me the invoice that agrees to this balance? And they'll show us and we'll record that we saw it and give the invoice back to them. In a nutshell, that's our job. It's our job. Well, we don't do that now. We review it after someone else has done it. Yeah. But yeah, so we'll have a team of accountants that will go out and do that, and we'll go out and see the team and the client, hold discussions with management about anything that's particularly difficult, and review the work to make sure that it's in line with accounting standards. So yeah, essentially.
I think that describes it. Right now, everything's done electronically. So, why did we ever bother going out to the clients and seeing those guys?
Because we pay good people.
So we're just receiving it all online now. We've created little portals where they can drop all their documents securely, so there's no risk of other people looking at them. So yes, COVID has made it a bit more tricky, but we can still perform our job.
Yeah. And so generally the person that, I suppose knows or deals a lot is the partner, and they'll come in and do a sort of high level review and make sure everything looks right. Yeah. Okay, so there are a lot of different types of financial statements and assurance over them. So
I think one of the questions also asked in advance was, how do we know by reading the different assurance levels, what does that mean about the company, right?
Right. So if you're looking at a financial statement and it's an audit report, then it should say auditor's report at the top. So it's pretty clear. You'll see from the example that Siobhan sends around later. Generally, the type of report that it is will be written on the top. Following that, you'll see, so sort of the types of reports that you'll see will be a financial statement audit, which is where we'll come in and issue an opinion on the whole of the financial statements. So, and this is generally, yeah, required by listed entities. The banks generally will want to see this, and it's sort of an, what word am I looking for? Like, it's just it's more of a full assurance, so less.
Okay.
It's not a, I guess it'll go through when we go through the audit report, it'll become a bit more clear.
Yeah.
So, and we also have a financial statement review report. So that will be a lower level of assurance. So we don't perform quite the same level of detailed transaction review that we would for a full audit, and it gives the readers a sense that the financial statements make sense, but it doesn't sort of say, we will tell you that these numbers are right. It says, we've looked at them and we can't find anything that says they're wrong, but we're not telling you they're right.
So basically, whilst what we told you earlier about, we would look at an invoice for financial statement audit. So for the top level, we look at the list of expenses and we'll request to look at an invoice. But for the next level down, what we will do is more sort of analytical procedures. So we look at what happened in one year, what happened in the other year. Does that look reasonable? If, for example, suddenly they've had 50 more employees in the year, but the cost for the employees haven't changed, we would wonder, well, something's not right here. And then specifically when those areas come up where we think, there could be a lot of risk here, or something doesn't look right here, is when we then would maybe go into more detail. But so generally it's not as detailed, the things we look at, as Sarah just said.
And so, and a review will also be generally over the financial statements as a whole as well. There are other types of special reports, and they have their own auditing standards, but essentially they will provide assurance over specific areas of the financial statement. So it could just be that you're a construction company and you're looking to prove that,
you've made that this much revenue.
Yeah, you've made this much revenue, or that you're essentially a going concern, so that if a creditor is doing business with you, you're going to be able to pay them. So there's a lot of like essentially relating to different areas of business. They'll need different things, and we will provide. We can go in and say, yes, look, your revenue is right, or your expenses are right, and we could do a report only on those things. Or like for example, in the public sector, there's a lot more of that. Like a specific grant will need assurance over the grant spending to make sure that someone's used the money the way they were supposed to as well. So the last sort of set of financial statements you'll probably see is an NTR. Well, we call it an NTR, but it's a notice to reader. So it'll come, and on maybe the second or third page will be a statement saying, essentially, this is a compilation only. So it's not something that we've looked at to any degree of, with any degree of critical eye. We've yeah, we have essentially taken clients' financial data and made it look pretty. So it made it kind of make a bit more sense in the context. But I mean, we would generally ask a question if things looked particularly strange, but essentially that's the client's financial information, and how they want to present it is up to them. So.
And we will state in this NTR, this notice to reader, we will state in there to say, you know, that this might not be appropriate for any user that are of these financial statements that are looking at it, and you know that we're not giving any assurance over the numbers. We've just basically asked management, can you confirm that these numbers are right? And unless they give us reason to believe that they're not, that's all we do.
Okay, so later on you'll get to see this audit report in all its glory, but for now I'll stick to the headline. So in an audit report, it comes out, and at the top is the opinion. So you'll see there, it'll generally be a clean opinion or a qualified opinion. So,
but we never say that something's absolutely right. So because as an auditor, we do not have the chance to look at, you know, 100% of the information, that there would not be enough, you know, enough days in the year to do that, especially for a larger company. We will, you know, when you read these opinions, they never sound particularly great. We would just say, you know, along the lines of, we think the information has been stated fairly, and then we use a word called in all material respects, which basically means we've applied a threshold and we ignore everything underneath this threshold unless there's a specific risk. There are some exceptions to this. We've only looked at everything over this threshold, which means we can't say anything about this, which means there's always a risk there's something wrong with this bit. We can only say something's wrong, like things are right with this bit, which is why, you know, we never say, oh, everything's right. We just say, you know, we can only give assurance to the level of the things that we've looked at. So yeah, it's never 100%.
Yeah, and so that level that we're kind of giving assurance over is always designed, so there's a lot of thought behind the scenes from our point of view that goes into it, a lot of judgment, but it's generally from the point of view that anybody looking at the statements wouldn't be affected by an error to that level. So if you're looking at statements that have billions of dollars of cash and billions of dollars of assets, no one looking at those financial statements is going to be worried about $100, you know, that we're missing out of petty cash. Like that's that's the sort of thing where there we would say, you know what, it's $100. Yes, it's important to the business or the person that got the money or lost the money, but as looking at the financial statements as a whole, it's really unimportant. No decisions are going to be made based on that $100. Basically, that's the concept there. Following on from our opinion, we'll come to like the basis for our opinion, how we formed it, and what it's looking at. So that will generally include, you know, the accounting framework that we've looked at the financial statements under. So if someone had to report under ASPE and we're looking at it under IFRS, there's going to be huge problems there because they've done things that don't match up. You'll also be able to see when you look at financial statements, which we'll go through later and talk about the notes, the accounts, those two should agree. So we'll be looking at a statement under IFRS, and further in the financial statements, it'll say, these financial statements were prepared under IFRS. So you'll be able to make sure that that's right. So there's other information. Sometimes there's an other information paragraph. So for example, if an annual report gets issued, we sometimes will look at that to make sure that it's right, and that will occasionally go in there. I don't know, is there anything else?
Well, I guess the only other thing, like what Sarah mentioned earlier, when we, for example, say we qualify or modify our opinion, there might be a funny little paragraph, which is called emphasis of matter paragraph. So that will, for example, say, yeah, generally we're happy with our financial statements, so we're going to do this whole thing around, you know, they're fairly presented in all material respects, but let's say their warehouse burned down in the year. So we couldn't look at any of their inventory, so any of their stock, any of their physical items that they're holding. So we would say everything else fine, but we weren't able to provide an opinion on this because, you know, the inventory didn't exist anymore because the warehouse burned down. Or let's say the warehouse burned down, or like the office, there was a fire in the office and some of the invoices went missing. So we would exclude certain areas, for example, where we say, yes, we're happy, but this area we're not happy with because we didn't have a chance to look at it, for example. There are completely different levels, other reasons why this might happen. These are very extremes and they don't ever happen. I've never actually had a problem by not being able to look something because something burned down. But it's the easiest example to imagine as to why we would struggle to, for example, provide an opinion on something. And then that means, so you don't just want to read the opinion, you also want to just look a little bit further just to see whether there's something where they're saying, actually, no, this area isn't great. Or let's say it's a subsidiary of a bigger company and they very much rely on that big company providing them with money, otherwise they wouldn't exist. So we would put a paragraph in to say, yes, they're fine, but if the big company stops giving them money, then they're not going to be around much longer. So those kind of paragraphs could be found as well, and that's definitely something you want to look out for, but it will be right at the top as well, together with the opinion. So we're not just hiding that somewhere in the middle. We're kind of making sure it's at the top and, you know, present for people to see.
Yeah. So slightly further down, after the good stuff, is the responsibility of management and those charged with governance of the financial statements. So essentially, that's laying out to you that we, the auditors, didn't prepare the financial statements. That's the responsibility of management, and management has told us that they've given us all the access to everything we need to form this opinion. So yeah, essentially that's the gist of it, but there's a lot more words that go into it. And following on from that is the same, essentially our responsibilities in terms of the audit. A lot of time, the most important, I think, thing to note in terms of our responsibilities is it has a specific paragraph detailing our responsibilities in terms of fraud. So there's nothing to say that, so we don't, as auditors, we don't look specifically for fraud. A lot of people think, you know, the auditors have come in and said it's okay, everything's fine. But there's a lot of things that go into the perpetrating of fraud that we're just not going to be able to pick up. If there's collusion, if there's a lot of things like that, that's not something that we're gonna see. So a lot of times we will just assert that nothing has come to our attention that there's fraud, but that's not to say that there is no fraud. Is that? Yeah.
That sounds good. And then we sign the thing.
That's it.
Boom. Yeah.
Yeah, it's a cause for celebration that day.
You do a big meal when those days happen, because it will cause us a lot of stress, and we will all be, you know, a couple of years younger and a couple of grey hairs richer. But I'm pretty sure you guys are used to that as well, because, you know, every business has deadlines, and not just us.
Okay, so I think we've been through.
Yeah, I think so. We've covered most of that. Right.
Yeah. Okay. So I think we should cover the first point on the slide. But yeah, if there's anything,
Too keen.
yeah, I know, she jumped away. Yeah, I was ready, but no. So yeah, she's spoken about if there's any reason we can't give an opinion. I guess yeah, the common misconceptions to an audit, which kind of have been covered, but we don't look at 100% of the transactions. That's the concept of materiality. And we are not responsible for the detection of fraud. So sometimes people think we are, but we're really not. And also some people think that we prepared it and we checked it, and we didn't prepare it.
So we have a department within our office, you know, that can prepare financial statements, but the problem is if we would prepare the financial statements and then we would review them, you know, obviously there is some sort of independence issue there, because how can we review something that we produced ourselves? So generally speaking, you need to make sure, this is called safeguards, that there are safeguards in place if it does happen, that, you know, the people from the different teams don't communicate with each other or anything like that. But generally speaking, we don't prepare the financial statements that we review. If we do prepare them for someone, then we can't also perform the audit for them. I'm sure it's the same for you guys. If you set up a contract for someone, you know, at the end of the day, I don't know if then the same firm would ask you to review that contract for the purpose of, I don't know, a bank loan, then that probably wouldn't be possible either.
Absolutely. Quick question before you go on. So when you are looking at the financial statements that you haven't prepared, you're just reviewing them, do you only look at the financial statements, or do you also look at other underlying documents and review those, such as if they're mentioning an acquisition and they're talking about a transaction, do you also review all of those documents? That's a question that's come in.
Yeah, absolutely. So I mean, we'll get to it a little later in, for example, in the sense of when we prepare, well, not when these financial statements are prepared, and then we come to the conclusion there have been acquisitions. Those are questions we ask. So we will always ask, are there any things either during the year or even subsequent after the year that we need to know about? Which is why, you know, that whole paragraph is in there to talk about management responsibility, because we can't know, you know, what's there if they don't tell us about it. So yes, we will. And then obviously, you know, for example, we do online research as well. If it's a larger company that, you know, obviously has just purchased something and they haven't told us about it, we'll be like, well, but it was just in the news. You've just purchased a new subsidiary. Why aren't you telling us about this? So yes. And then, you know, how we talked about the general ledger earlier, they can't hide anything in there. Like, because at some point, if a transaction happens, there will have been money going out, right? And if suddenly that money is missing, there has to be a second part to that transaction, because as we said earlier, all of the transactions in total need to total to zero. If they don't, it would mean they've only recorded one side of the transaction and they haven't recorded the other side. So we don't just get a set of financial statements and they go, hey, we did 500 million of this, and we go, oh, okay. No, so they give us the detailed breakdown of each one of the transactions, and then we'll pick our, we call it sample, based on this materiality level that we just talked about, based on this threshold, we'll pick a sample that will be an appropriate number to ensure that we are looking at enough invoices and enough supporting documentation to ensure we're not missing anything. Yeah. But yeah, I mean, there can always be something in there, obviously, that we don't see, because yeah, we're not almighty, but we try to obviously, you know, fan it out a bit, and then sort of mainly look at the larger transactions, but just to ensure that they don't feel safe, you know, management don't feel safe by trying to hide something in the small stuff, we will always ensure that we're just picking some of the small stuff to ensure that, you know, which, you know, one would care about. Sorry?
We just lost you, but you're back now.
Oh,
okay. So up until what point did you hear us?
Till most of it, I think, until like the last word, I think.
So basically, yeah, we do always make sure we pick some small transactions as well to ensure that, you know, they're not hiding something in there that we might not see. But again, you know, we can't look at it all.
But any big transaction, we will definitely have a look at. So acquisitions, 100%, we audit them the same as we would audit the rest of the financial statements for them.
All right. Now we'll get to the really good stuff. So the main bit of the set of financial statements that, you know, sort of make up the face, the big bits, are called primary statements. Everything else is basically in the financial statements to support what is in those so-called primary statements. So we've got 4 primary statements, plus minus. We don't have to get into too much detail there. Again, it'll depend on the size of the company. Sometimes, you know, you might need an additional statement here or there. Will also depend on the framework, but overall, you will always definitely see a minimum of 3. The rest of the time, there'll be 4. So in Canada, your set of financial statements will always start with something called the balance sheet, or the statement of financial position, which shows at the end of the year, when we're done with, you know, our period that we're looking at, it shows it at that point in time, that date. Let's say it's the 31st of December year end. On the 31st of December at, you know, basically whenever they close their books on that day, that's what we're looking at on the so-called balance sheet. So it doesn't show you, you know, all of the transactions that happen throughout the year. It just shows you where we got to at that point. And then we've got the statement of profit and loss, or statement of comprehensive income. These different names depend on, you know, whether you're reporting under, we called it earlier, the International Financial Reporting Standards, so IFRS, or whether you're reporting under ASPE, So the Canadian local standards, they have different naming requirements. They're all the same thing, just different name. And that will show you the actual period. So let's say, you know, you had one contract throughout the year, you earned $500. You add that up times 12, and you'll have that total number in there. So usually this would be 12 months because a usual reporting period is always a year. However, let's say the company only started existing, so only incorporated in November, and they want to have a 31st of December year end, then they would just go 13 months because reporting on 1 month, there's no point. So for that first period, they'll go the longer bit, 13 months, and then they'll start with their regular 12 months period. So that's usually the only reason. Or for example, a company, you know, gets liquidated during the year, which means, for example, they get liquidated in April, they only started on the 1st of January, their new period, then it'll be a shorter set of financial statements. So those would be the main reasons as to why it wouldn't be. It could be, for example, a new subsidiary gets bought. Those are sort of the main reasons why it's not 12 months, but most companies will go for that 12-month period. All right, and then we've got the statement of changes in equity. So each company, you know, has some sort of owners, and they've put some sort of money into the company, so they've got some sort of interest in this organization, and it basically displays the movement throughout the year in those equity accounts. But we'll get to that a little later. And then we've got our beautiful statement of cash flow. Just as the name suggests, it's just all of the cash that went in and out. And on this statement, we're not looking at, you know, when did a point happen? We're looking at what actual physical cash moved and in which account did it move, why did it move. So that will literally have the actual physical cash that left or came into the company. All right, so I'll start with the balance sheet. By the way, this is a Canadian thing. So for example, in the UK, it's the other way around. It's the statement of profit and loss first, and then it's the balance sheet. I don't know why over here we do it the other way around, but that's the way it is. All right, so as I already said, at the top right there, you can see as at December 31st. So this is our point in time. So rather than being this period that I talked about, Sarah will get to that on the next primary statement. We're literally looking at it on the 31st. What did we have in our bank account? What items of, you know, equipment did we own at that point in time? So you can see the two big brackets. So we've got total assets, we've got total liabilities, and then right there at the bottom, you can see we've got our equity. So the total assets, reason why that's broken down into something called current assets and long-term assets is a little bit like the name suggests. Current means anything within 12 months. Long-term means usually anything above 12 months. So for example, if you have a piece of equipment, usually that equipment you won't just have for a year. So let's say it's a, I don't know, it's a winemaker. And they have a machine that bottles the wine, and that machine will, you know, on average last for 5 years before they have to replace it, which means we would put it into our long-term assets. So the general description for that is called property, plant, and equipment. You could also find land in there, for example, if they own a piece of land, so that will be a different line item. Yeah, those are sort of your common ones. And then you've got current assets, which are the 1 year assets. So basically your cash, you've got a bank account. Usually, I mean, I don't know about you guys, but my bank balance unfortunately changes a lot, usually goes down. And that's, for example, part of your current assets. And then accounts receivable. So let's say, you know, I gave Sarah $50 last month, still waiting to receive those $50 back.
Okay, my dear.
But usually Sarah is a good girl, and she doesn't take more than a year to pay me back my $50. So that's why that would be under current assets. So same for any company, if they've, sold someone, let's say, a bottle of wine, but you've bought it with, you've received an invoice, not with your credit card, you've received an invoice and you're supposed to pay that invoice, let's say within 30 days. Sometimes maybe they extend you the 60 days, maybe 90 days if you're a really great customer and you buy a lot and you usually pay on time. However, you can tell from these ranges, it's never going to be a year. It's usually somewhere in the 1 to 3 months bracket. So again, it's under our current assets. Inventory, again, speaking about the winemaker, yes, you might have guessed from this, I love drinking wine. Usually that wine doesn't sit around for that long. Maybe in your cellar then to get nice and aged, but usually they'll sell it to you reasonably quickly because they want to have space to make new wine. And therefore, again, that would change around quite quickly. So we're expecting that to be less than a year. Maybe if they specifically record some wines, that would sit there for 3 years before they sell it, we would then report it under the long-term assets. And then, any prepaid expenses. I don't know about you guys. Let's say, I don't know, in the UK, you have to pay something called a TV license, and you would usually pay that for a year in advance. So let's say I started moving to the UK in April and I have to pay it for a year, but I prepare my financial statements at the end of December. Means I've got a couple of months that are already prepaid for the next year. So I would also record those there because they would usually be, basically redeemed within less than a year. And then same applies to those liabilities. So anything we owe to someone, rather than it being owed to us or it being already ours, like the machines, like the cash. We've got current ones, same rule applies, 12 months, or we've got long-term ones, which means anything above 12 months. So to talk about the long-term ones first is the easy one. So you had to buy that piece of machinery for 2 million, but you only had 500,000 in your account, which means you had to borrow 1.5 million from the bank. Usually you're not going to pay 1.5 million back in a year because no one makes that much money. Let's say the company doesn't make that much money that they can repay that within a year, which means they'll have 2 portions. They'll be able to pay 300,000 back over the next year, and the other 1.2 million will be repaid after that. So you could record the bit that you're going to repay over the next 12 months. You can record that under the current bit, and then the other bit will go into the long-term bit because you're not repaying that over the next 12 months. You're not touching that, that just sits there. And you still owe that money though. Okay, so then into the current ones, as I just said, for example, the 300,000 of the bank loan that you will be okay to repay over the next year, that sits there. And then same as the other way around, people owe you money, you owe people money, for example, because they've sold you, I don't know, the cork to close your wine bottle. So you need to give them some money. So they gave you 5 boxes and they asked you to please pay the bill within 60 days. So you would say, okay, I've got my boxes already, but rather than my cash going out, I need to record something that's a liability because I still owe them that money. I still haven't given them that money. So that would go there. Or for example, you see a demand bank loan here, which means, yes, maybe the bank gives you 1 million. You're like, yes, I've got 1 million now. I can buy new things for that. But the word demand in front of it means they can go, okay, I'll have that money back, please. Which is why we will always record that under the current liabilities, because even if the bank isn't going to request that back over the next 3 years, they could at any point. So we need to show, there is a substantial risk of this money having to go somewhere quickly. So we report it under the current. And then, any taxes that you pay, all of us, have to pay our taxes within a year. So those things go there as well. And then we talked about the equity portion. So that will usually be, your share capital. So we spoke about this earlier. For example, you've got a couple of owners of a business. They all, let's say you 5 owners, each one of them owns 20%. So they will have put some sort of money into the business to say, this part of the business belongs to me. So that's our share capital. And then our retained earnings, just like the name suggests, means, over the last 3 years, you've made great profits. You've kept the money in the company to be able to spend it, for example, in 3 years' time on a machine or something. So you're just keeping your little profits there. So those are our retained earnings, anything we've earned over the past, but we haven't spent it on anything yet. So that's, I think, the easiest way of describing what our retained earnings are. Right?
Yep.
All right. Next, on to the fun.
Okay, so here we are, the statement of income. This also has retained earnings on it, but normally this would be the statement of financial position, or, statement of financial performance, or statement of income. So you'll see from the wording at the top that it's for the period ended, so that'll be, or for the years ended, so that'll show you, if it says the year ended, you'll know it's for a year. Sometimes it'll say period, that'll clue you in that it might not be whole year, could be less, could be more, just depends. So that'll give you a clue. Yeah, but you'll see on the balance sheet, which Patricia was just talking about, at the top it'll say as at, so it's just like as at the point in time. So that's kind of how you can tell. So for example, so on the statement, normally at the top, there'll be the revenue. So this will be the money that you've made during the year for the things, all the wine you sold. And that'll be shown at the top. If you had to, had inventory or had to sell things as part of that, that will go into the cost of sales. And then generally that'll show you the gross profit. So your cost of sales would be your wine bottle corks and your bottles and the grapes, essentially. Yeah. And your gross profit is just the difference between the two. So that shows you how much money you've got to pay the rest of your bills. It's, essentially that's it. So everything that goes into making your main product to sell, that you've paid for that, and what have you got left to spend on the rest of the business expenses you need. So
people to make it
yeah, so you've got, so on this example here, it's got the things that you'll generally see in a set of financial statements. So expenses, the first one showing is amortization. So that'll be something, you've got your wine bottle machines and they're only lasting for 5 years. So as it gets older, the value of that machine gets less. So say it started off at 2 million, at the end of this year, it's only worth 1.5 million. That $500,000 it's shown as reducing your net profit, your equity, it reduces your kind of interest, because at some point you're going to have to replace that machine, and it's kind of attributing the cost of that machine over the life of it. Yeah. Okay, question?
I do have a question. Yeah, somebody asked, this is going slightly back to what you were saying previously, but wouldn't including the line for the current portion of the term bank loan and term bank loan be counting the current portion twice?
No. So in the long-term portion, it would only be the long-term portion. So let's say you have 1.5 million that the bank gave you. You would record 300,000 under the current one because that's what you're repaying now, and then the 1.2 million, which is the rest, you would put under the long term. So in total, it would make up the 1.5 million you still owe the bank.
Yeah. We don't have an example of the notes, but a lot of times next to, you'll see, if you look at a set of financial statements, next to, for example, sales will be note 5. Next to the loan would be note 8. And then in that note, it will give you a lot of the detail. It will tell you the current and non-current portion together, so that on the whole, you can see the amount of debt you have. So yeah, later on we'll talk about the value of the notes, but essentially a lot of the detail that you're seeing, and all the questions you'll ask, the answers to those can be found in the notes. So I suppose it's a good reminder that, when you're looking at these statements, there is a lot that isn't there. So like, we wouldn't know, looking at sales, I don't know, that could be five different sales lines, or business lines they have.
Could be the red wine, the white wine,
all together. And generally, if there's any reason that you wouldn't know what that was, and it's a material number, should have a note next to it where you'll be able to read the detail, and that should have everything that you need to understand.
Perfect. Thanks, Lady. That's a really good reminder, everyone. Make sure you read the whole of the financial statement, including the notes, which typically we'll gloss over, but especially for you guys as lawyers, all of the detail you need is in the notes section. So it's almost worth pulling it apart and having them side by side so that you're not constantly flipping backwards and forwards. So, and hopefully that answered your question for you.
Yeah. Anyway, just let us know later if it's not.
I'm glad you're paying attention. It's great.
Yeah, good question. Yeah. Okay, great. And so I suppose, yeah, going through generally, I'm just going to go through the general things you'll see as we've got them here, but bad debts would be, you know, if Patricia, if I'm never going to pay her back. So I've run off with that $50. She's never seeing it again. It's a loss to her. So what she's doing is she's saying, I'm never going to get that money back. Want to get this, yeah. And so essentially, it's just showing that it's a loss to her.
So I would reduce the money that I'm being owed, what we saw earlier, the accounts receivable, and I would increase my expenses because now it's an expense to me. Before it was still money owed to me. Now it's not anymore. So minus on my little accounts receivable, plus on my expenses because they're going up.
Yeah. Yeah.
Look at this double entry thing. You're going to be stars after this.
Yeah. So essentially, interest and bank charges, we all know what those are, but yeah, you owe money, you don't pay it back straight away, the bank will charge you interest. And professional fees, that's you guys. Or us, yeah, as well. And salary and wages. So, yeah, I mean, I think selling general and administrative, it's all the rest, you know, it's the office equipment, I don't know, just the miscellaneous.
Whatever kind of business it is, the expenses could be completely different. You know, certain types of insurances might be on there. It's, you know, different type of business, different types of expenses. The ones you see the most are the ones we put in here because mostly any business will own some sort of equipment. Therefore, they do have to have this amortization bit. Most business have staff, therefore they'll have salaries. If you have equipment, usually you need to repair that or somehow maintain it. So you'll have that as well. Most of the time you'll have maybe a lawyer on retainer, or you need to get your financial statements done, which is why you have professional fees. Most businesses also have to borrow some money, so you have the interest. And therefore, yeah, we just try to, you know, pick out the most important ones that you'll come across.
So after you've made all your money and spent it all on the things that are necessary to keep your business running, you'll end up with what's left, which is your operating profit. So that's your income before tax, right? So that's how much money you made before the government comes in and says, hey, give us what you owe.
And operating, because these are including all of the expenses to operate your business.
Yeah. Yeah, and so after that, the line it'll show you the income tax for the year that's due on that income. And then whatever's left at the end, that's the net income. So that's, you saw the retained earnings, that's the amount that goes to that. It's the money that you've kept in your business, or essentially it's not the physical money, but like the property, the cash that's gone up, the accounts receivable that's gone up to hold within your business to give you more value. Yeah. And then, yeah, at the end of this statement is the retained earnings reconciliation. Sometimes that's shown in a separate statement. So yeah, but
if you add up the opening with the net income you've made in the year, you're going to get to the closing. Yeah. So as simple as that. And the opening will always be what you finished with at the prior year. So which is why you see here, for example, it's 1207 at the opening, and it was 1207 at the closing from the previous year. And then yeah, the difference will be whatever you made in the year. It's as exciting as that. All right, yeah, this was you, right?
Yeah, so
just gonna feed my cat because otherwise she's not gonna leave us alone soon.
Okay, so yeah, the next statement that we don't have an example here of is the statement of cash flows, but you'll see every statement of cash flows at the top is going to generally start with the amount of profit you've made, and then have transactions which will show you the cash movement. So it'll be broken down into 3 sections, which is operating activities, investing activities, and financing activities. So the operating activities is anything that's gone into your general day-to-day operations, the things that have gone through your profit and loss statement, or yeah, it's essentially that. The investing activities, they're anything to do with, investing. It's if you put money into a term deposit, you're investing that money for later. That'll show as a cash outflow to you. If you had term deposits and then they matured and they came back into your bank account, that's money, cash money coming back into your cash account. That will be, an increase there. So, and a financing activity is just anything that you've done to support your business. So you took out a bank loan, that's money coming in to you, cash money, through financing. If you did a share issue, if a company did a share issue during the year and they got a lot of cash in, that's a financing activity, and that'll be an inflow of cash to you during the year. At the end of the statement, it'll show you, it should always agree to the cash in your balance sheet or statement of financial performance. So yeah, essentially it's showing you how you went from last year's cash in the prior year to the cash you've got now.
So basically bank balance, beginning of the year, bank balance at the end of the year. And, the bit in between needs to agree to all of your activities. And if it doesn't, something's wrong. Sometimes it's hard to figure out. The bigger the company, the more of a mess. All right, now we'll get to those beautiful notes, not to be disregarded. They can be lengthy, very lengthy, but especially when something's not clear, especially when something's particularly large, a material balance over this threshold, we need to put in a specific note to explain in detail what it refers to. Those notes are also handy. Sometimes, a company has a name, that name doesn't really give much away. You don't really know much about this company. So your first point of call is jump into those notes. I'll tell you the nature of the business, what they do, when they've been incorporated, what framework they're reporting under, whether they do this IFRS thing or ASPE thing, and then, what kind of tax they're using and anything like that. So it's your best point of call. Literally, you flick through the statements, and the first page where all the words are on, after you've looked at come across the numbers, is where you'll find that important information to know what this business actually does, how long it's been around for, who potentially the shareholders are, anything like that. And then as we've already said, the larger balance will be broken down for, let's say, for example, you're owed money, right? I don't just have Sarah owing me $50. I've also got, a partner owing me $100. I've also got, a couple of other friends. It's so generous. And then, maybe I can group them all together and I can say money owed from friends. Usually this would be, related parties, to use the professional term. But it could be, money owed to me by customers. And, sometimes if I've got a particularly large customer that makes up the majority of this balance, I would maybe have to, note that down specifically, because 50% of the money that's owed to me is from one customer only, which means I'm very much reliant on that amount. Because if I don't receive it, that could potentially mean, I'm in jeopardy, because I'm also owing the money bank, which means if I don't get that money, how can I pay the bank? So when someone would want to read these financial statements, they would want to know if I'm relying on, for example, one amount very specifically coming into me because it's my biggest customer. And if I'm losing this, then, I'm not doing so well. And then generally it would explain to you, the way things are recognized. For example, let's say revenue, we've spoken about it earlier. Sometimes you can recognize something on a cash basis. So I just recognize revenue whenever I actually receive money, or the accrual basis and those kind of things. It'll all be explained in these notes. If it's IFRS or ASPE, it'll be a given, then you just have to know, but you know that now, don't you? All right, so the notes are generally a good point to look at. And as Sarah also said, for example, there'll be a note on your primary statement behind each one of those balances that is big enough to be explained. And then you don't have to try and search for it frantically. It'll tell you it's note 7, so you just go to note 7. All right. I think we've covered that. Oh yeah, so one of the additional points, if you go usually right to the back of your financial statements, there's something called subsequent events. which will tell you about any sort of material transactions that we think, or that the business thinks, are relevant to its users. So, for example, let's say they've acquired, you know, a piece of machinery after the year end, or they've acquired a new subsidiary or anything like that. This is where they would tell you about. So this year, as a standard, what we had to get each one of our our clients to include was a note to tell us about COVID and how it is impacting their business. Because for, you know, anyone who reads those financial statements, they will want to know, right? I mean, you would want to know, let's say you are, you know, looking to potentially invest in this company, or, you know, you've got money with them because you've lent them some money because you're a bank. You would want to know, how did this impact the business? So, for example, if you're in the education business, you've got a lot of international students. Well, this year the international students couldn't come because it was COVID. So what did that mean? Did that mean they made less money? Does that mean they're going to go bankrupt? You know, so this is where we would kind of talk about anything that's substantial to the business that might have an impact. All right.
Oh, I think, yeah, something else to look for in the notes, which is probably relevant to you guys particularly, is any potential liabilities. So contingent liabilities or lawsuits or anything like that will be disclosed in the notes as well. We, as auditors, generally will get confirmation. So this is probably something that you'll see if you do work with clients. You'll get a letter from us, well, a letter from your client, but from us, saying, please provide our auditors with details of any outstanding claims. So yeah, if someone, like a lot of times, say for a municipality, someone slipped and fell on council property, then someone's suing them because there wasn't the proper signage, for example. So it would be, if that number was material and not sensitive in any way, it would be disclosed. Otherwise, if it was sensitive, there would always be, you know, a note saying that these claims did exist, but potentially not giving all of the detail. But generally, yeah, generally there is a note on a commitment or a contingent liability.
And that, I mean, that's a really good point. So it'll depend on the probability of that happening. So that's something where then, you know, you as a lawyer would be consulted and you would say, it's 35% likely, you know, your client will be liable to pay $500,000. And, you know, if it's only likely, you know, we would, you know, if it's possible, but not, you know, probable that it'll happen, for example, then we're only going to disclose it. If we actually think, you know, there is a pretty decent chance that they're going to have to pay some money, we would even have to go a step further to say, okay, we're going to put this on as a liability because there is a very high chance they're going to have to pay this money. So we're not just disclosing it, we're actually saying, yeah, you're going to have to recognize this as a liability, you know, what we talked about earlier, where they have sitting the bank loans and things. In addition to that, we would also add this to there to say 500,000 for lawsuit. Potential still, but if the potential is high enough, then they need to recognize it. But again, depending on the standard, different requirements, how likely it needs to be for it to go on there.
Yeah. Good reminder to read the notes. Yes, you're looking at the numbers, read the words.
Have the words, right? All right, we'll move on to some beautiful ratios.
Okay, so yeah, we're going to take you through some ratios in a little bit, and what the ratios will do is to help explain the financial information, you know, without looking too much at this is cash, this is accounts receivable. It's like, on the whole, how is the company going? How, like, are they performing well? Is this better or worse than last year? These are ratios which standardize. You know, if you had two businesses that did essentially the same thing, you could compare these ratios to see, you know, which one's doing better or worse, or, you know, how they're running their business in a different way. So I think, yeah.
I think one thing to note here, for example, some, again, we're talking about bank loans, but some banks will require for you to have certain ratios. And they will use that in something called a covenant. I'm assuming that word is probably known to you because you're lawyers.
You
So-
came up with it.
So they'll have a so-called, we call it a bank covenant. So they have to reach a certain ratio, and if they don't reach that, there's a risk that the bank will pull the loan and say, we'll have this back now, please, because clearly you're not performing as well as we'd like you to perform. So that's also a reason why, for example, when you look at your contracts, you know, there might be some sort of covenants in there, and these ratios might just be important to know whether that business is doing as well as it should be and whether it's following the rules that's been given.
Okay, so yeah, we'll just start off with some of the liquidity ratios. It just gives you an idea of how, well, I'll start off and I'll explain one and it'll kind of make more sense. So the current ratio, essentially it'll show you how many current assets you've got to pay all your current liabilities. So as Patricia said, she's got all these debts owed to her from customers, from her friends,
From all
her
my
friends,
money,
owe
that's
her
my
money.
current.
That's her current assets, and she owes money to the wine bottle cork people. So, so essentially, if you divide the assets you've got by your liabilities, you'll see for every dollar of assets that you have, how much liabilities you can pay off with your current assets. It's essentially
better, because it means, you know, I've got 10 friends owing me, but I'm only owing 5.
Yeah. So it's essentially just showing you, if you paid everything left, the percentage that you would have remaining. Yeah. And so the current ratio and the quick ratio are quite similar, but the quick ratio would take out anything that was not immediately convertible into cash. So it's going to show you, so for example here, it would be your current assets less your inventory balance. So
that might take a while for me to sell a line of course and get some cash from that, which is why we're not using that as part of our current assets.
yeah, but whereas you've got cash in the bank, you could pay your debts tomorrow with that, or your accounts receivable likely to come in within the next 30 days to 3 months. That's essentially very liquid. So that's kind of saying right now, if all your creditors said you have to pay us, how much money have you got to do it?
And that's why we call it quick ratio, because it's quick money.
Right away there.
Here we have our debt to asset ratio. So it really is showing how solvent the company is. So it's your total liabilities divided by your total assets, and essentially it's showing how much you've borrowed to get these assets. So if you had your $2 million wine machine, but you had to borrow $2 million, that's not great, because you've got nothing left to kind of support your business with. And so I suppose, and one of the ones which is generally in a bank agreement is the interest coverage ratio. So it's going to show the bank and how well a company can satisfy its interest payments. So for example, you've made $200,000 this year, your interest expense was only $20,000. You can pay your interest expense 10 times before there'll be a problem, right? So the banks are interested in, if your interest expense was $300,000, that's a problem.
Can I anticipate the next question? What does Ebitda stand for?
That's a problem. So anyway, that's a problem, because that'll show you can't even pay your current interest. The bank will say, give me my money back, because you won't be able to afford to finance it. We have used Ebitda here, which is an acronym. So it does mean earnings before interest, tax, depreciation, and amortization. And it'll be in the glossary, but it's a very common term, and it's essentially it's like essentially asking, what money have you made before the non-cash and non-kind of financing items? So it's taking out the interest you've already paid, because you're showing how much of it you can pay. Taking out your tax, because if you don't make money, you don't pay tax. And
depreciation and amortization, whilst they increase your expenses, as we've just said, they are kind of fictional expenses, right? Because yes, you've got your machine, it'll last for 5 years, which is why you're, decreasing each year by, the whole amount of the machinery divided by 5, and then each year you're subtracting that, but it's not actually cash you're paying, right? It's just in relation to you having owned that machinery and showing if you would sell it 2 years later, how much would that machinery roughly still be worth if you were to sell it then? So it's not a real expense, like it's not a cash expense. Yeah. So you want that to be nice and high. The bank usually wants it to be a certain level. I can't tell you what, because it's completely dependent on the bank and on the business. But basically the higher that is, the better, because the more money you have to pay your interest. Okay. All right. Next. What do you want to say some more? Okay. So we'll get sort of into some of the activity and profitability ratios. Some of the common ones is called accounts receivable turnover. So accounts receivable, again, for example, Sarah owing me money, and basically I'm looking at how quickly am I receiving my money, because that money will be, it'll be going up or down depending on whether it takes longer for me to collect the money that I'm being owed, or whether I'm becoming quicker at it. So this is something great for you to use if you compare 1 year compared to the next year, because it's a great indicator in how much better or how much worse the company has been doing in making sure they're going to be receiving their money that they're being owed. You can also count it, for example, you can also calculate it in days, where you actually switch it around. So you take your receivables divided by your sales and then times 365, and then it'll actually tell you the amount of days that it takes you to collect your money.
This is something that we look at as auditors to see how a business is going. And for example, if this changed substantially, we would be asking questions like, why is it taking so long for your customers to pay you? Are these actually real assets? Like, are they bad debts? Have I run away with Patricia's money and I'm never going to pay her back, but she's still counting it as an asset?
It's been 4 months and I've still got it on there, but it's pretty obvious I'm never going to receive that.
Yeah, so these are clues. They'll just give you clues to see, if there's anything in that balance that potentially shouldn't be there.
And it could be something harmless. It could be that they've just extended their credit to their customers because they've been loyal customers, they've always been paying on time, and because, for example, COVID happened, you just want to cut them some slack. So, you've just extended your credit terms by 60 days to 60 days instead of 30 days, which means you would expect for your money to come in slower because you've kindly, allowed for your customers to take a little bit more time to pay you. So those are then questions we ask, right? So it could be something completely harmless, but it could also mean something pretty severe. All right, so inventory turnover then is very much similar along those lines. In this case, you want it to be quicker rather than slower, because it means you've got your wine bottles sitting there. Why are you suddenly not selling them? Why are they sitting around? Are you struggling to get rid of your inventory? Does that mean, do I have to worry about them going bad, and then therefore you can't actually ever get your money back for the inventory you've got sitting there? So basically this is something you want to go the opposite way. The quicker they can get rid of their inventory, that's great news, because the quicker they make cash, because otherwise it means you've got your amount. Let's say I've got 2 million of wine bottles sitting in my inventory. If I suddenly can't get rid of them anymore, maybe that means I will never get rid of them. So I have to decrease that amount from 2 million maybe down to 500,000, because at the current price, there's no way they will ever be able to sell that. So same principle here. Again, you can do inventory divided by cost of sales times 365 to give you the amount of days that it takes for them to sell the inventory. All right, accounts payable turnover, exact same principle. This time it's how long does it take you to pay your suppliers. So again, this is something you want to be rather lower than higher. It could be something, again, as innocent as them having extended credit to you. So they now just require for you to pay within 60 days instead of 30 days. Perfectly fine. Great explanation if it's true. But if you're suddenly struggling, that means maybe you don't have enough cash. Maybe you'll never be able to pay them, which means you'll your business is not doing very well. So it's a good indicator. All right, and then gross profit margin. Sarah's already spoken about it a little bit earlier. So the gross profit is the bit that you get to after your sales minus your cost to sell. That's your gross profit, and then divided by your sales gives you the percentage of your margin. How much money are you making per, unit of revenue that you're earning, basically. And that's something you want to go up. So, the bigger your margin, it means the more money you receive for something that you sell. So let's say I'm selling this cup, right? And it cost me $1 to buy this. I'm receiving $5. Next year, my price has gone up. I'm now receiving $7 for selling this, but I'm still only paying, $1 to purchase it. So you would expect the margin's gone up, and that's great for me because I'm making more money per cup that I'm selling. Okay, return on equity, ROE, or also ROI, being the return on investment. Similar principle, basically the money that's been put into this business, how much income, how much net income can I create with the money you've given me? So you've given me $20, how well can I turn that into $50, basically, is what this tells us. And then we've got the return on assets, similar principle. I've bought a new machine. How quickly and how well can I make money with this machine? Can I produce, 50,000 wine bottles? Can I only produce 20,000 wine bottles? So you'll sort of take your operating income. So after everything, remember all those expenses we had our revenue at the top, our sales, then we had our cost of sales, and then we had all these expenses being salary and all of that. After all of that, how much money am I making based on, the assets that I'm owning, based on the machines that I'm owning, for example. All right. So these are some of the main ratios that we've picked because I think we think they're good indicators. If for some reason as part of your studies, as part of your exams that you need to take, there are more ratios you need to know about. If you're struggling to somehow, even if you find them on the internet, you're not understanding them well, you need some additional explanations on them, anything like that, give us a shout. We're happy to, give you some guidance, give you some explanations, and yeah. But maybe we'll have a few more that you want to ask about in the questions after. But just to warn you in advance, we don't know all of them off by heart, so we might not be able to answer your question without Googling it ourselves. Only advantage is we'll probably understand them quicker than you do because we will have, chances are we will have either seen them before or, we are here to be able to.
We understand the terminology, yeah, because we're always used to it. So you will get the glossary, and that's usually the link there.
Yeah, so in the glossary again, we've just put in, the main bits that we think are words you might commonly come across. But yeah, you can refer to this link as well. It basically has every single accounting term under the sun on it. So yeah, we hope that will help. And now we can move on to the exciting list of questions.
Ooh, well, thank you, ladies. I don't know about anyone else, but my brain is on fire right now with lots and lots and lots of information. For anyone who's feeling even slightly overwhelmed right now, that is 100% normal. Do not worry about it. These ladies have been doing this for years and years. And honestly, the only way that it really starts to make sense is when you start to look at a financial statement and you start going through it. So one of the reasons why they've both agreed that you guys can have the slides and you can have the example of the audit report is so that when you do look at a financial statement, you can grab these slides and you can cross-reference them backwards and forwards as you're going through your financial statement. And hopefully your memory will be jogged from what Patricia and Sarah have been saying tonight, and it will all come flooding back and it will make perfect sense at that time. But do you guys have any initial questions? I mean, in amongst the fog that you're all sitting there in, slightly glazed over at this point, does anyone have anything they would like to ask Patricia and Sarah at this point? It could be anything. You could even ask them about their careers in general and what life is like as an auditor, because at some point you're probably going to come across an auditor and they're lovely people. You don't tend to get very much time to talk to them as lawyers. They tend to get shuffled into a room and they just demand documents from you. So you don't normally get to chat to them often, but here's a great opportunity if you have some questions. So please do either raise your little hand using the little icons, or just drop it in the chat box. By all means.
Hi
Joel,
there.
go for it.
This is Oran.
Hi.
First of all, I'd like to thank Patricia and Sarah for presenting this evening.
You're very welcome. Thanks for listening. Thanks for not
Very
falling asleep.
informative. Thank you. My question is, in your experience in auditing law firms, and some of the problems and challenges that you've encountered, could you share a little bit of that with us, and any tips that that folks that are working in the law firm, any tips that you can give us so that those problems will be mitigated or will be prevented?
Yeah, so I mean, most of the time we'll probably be dealing with your finance department, because you know, at the end of the day, we are interested about the numbers. So the main reason why we would speak to the lawyers directly would be, you know, for some of the documents that we might need. So the best advice is, if you receive a list in advance of documents that we might need, it would be great if you get that together before we rock up. And otherwise, you know, if there are some documents that, you know, might crystallize throughout the audit whilst, you know, the team is out on site. For example, it'll be yeah, just helpful to be cooperative and just, you know, pass on what we need. And, you know, we are fully aware of you know, the concept of confidentiality. We are hired in a position where, you know, we would never share any confidential information. And so, you know, there isn't any worry around that. You know, sometimes there are some companies out there where we even need to sign some confidentiality agreements because it's, you know, for example, actively trading company, if any of the information would get out there, you know, insider information to buy stock or anything like that. But yeah, does that answer your question? I mean, maybe
Would you be able to give us some examples of some of the common documents that law firms would have to provide to auditors?
So I think the main one is the confirmation of of any issues or any claims. So that's essentially every audit client, their lawyer will get a letter asking, please provide our auditors with details of any claim. If there are claims that we know about, normally they'll be detailed on the letter as well. So these be asking for, you know, how much is the claim, how likely it is that this claim will be paid, and is there any legal action that's happening right now? There's, you know, a lot of times if there are issues, we'll arrange a call, but initially it'll be a request for a letter.
Also, if there's transactions, Oren, particularly if you're doing public company work, so you're working for a company that's listed on a stock exchange, you may be asked to provide various supporting documentation from to do with those transactions. And that will be because the company who has actually engaged the auditor has given the auditor permission to speak to you as the lawyer directly to provide that information. Typically, it's because you have a company that just relies on their lawyer keeping all of that information for them rather than them keeping it in-house. So I talk to my clients' auditors almost daily, especially at this time of year where we're doing a lot of financial statements, because I provide that directly for them. But it will depend on the relationship you have with the client and the relationship that the auditors have with the client, so the company, on that one as well. And in which case you'll be providing copies of the agreements for the transactions, and then all of the supporting documentation such as directors' resolutions, shareholders' minutes, shareholders' resolutions, any statements where if a director has recused themselves from voting because they have a material interest, you'll also be providing information like that. You also may have to provide things like shareholder registers if it's a private company. You'll be providing stock option registers, warrant registers, so that they can see the transaction that those warrants and options were actually issued in exchange for the funds that were coming into the bank account at the right time, especially if you have a company who's doing a large number of warrant and option issuances and exercises. That might be one of the spot checks that Patricia and Sarah were talking about earlier, is they might request some of that information to confirm that those transactions actually did take place.
And if we do specifically audit, for example, a law firm, we would usually audit them for, you know, client monies held, because I mean, I've only done it in the UK, I've never done it over here. But I'm assuming it's similar rules over here as well, that, you know, you're not even allowed to be out by 1 cent, because
there is no materiality in client trust money. So every cent has to be accounted for.
Thank you, Shubin, and thank you, Patricia and Sarah.
Perfect. Okay, so I have a couple of people waiting in line to ask questions. Janet, I think you want to ask a question too, so you'll be number 4. So first up, Jawad, then we'll follow by Juan, and then we'll go to Janet.
Hi. So a quick question from me. How often does, you know, I know that one of you said that it's all about numbers, but then again, you also consider legal claims that may be against the company that you're auditing. So how often does your work cross over from numbers to legalities? Do you need to sort of be wary of possible claims, or do you only consider the numbers when the claims have crystallized?
So we consider possible claims as well. So we'll make a lot of inquiries of management. If there's in-house lawyers, we'll speak with them as well regarding claims, and also receive the confirmations. If there's something that could potentially happen, that the amount hasn't been decided yet, for example, but it is likely to still be paid, we'll still disclose that in the financial statements. So, yeah.
Or like, I mean, in terms of agreements that we look at, you know, for example, we mentioned the bank loan earlier. So, you know, if there is any large number that is based on a contract, we need to review those contracts. So for example, let's say they have a large bank loan, we need to in detail review that bank loan. And it's very troubling for an accountant to read hundreds of pages of words, because that's not what we do. But we need to then, you know, filter out, you know, the important bits. So for example, I've had a chat with Siobhan as well in the past. You know, we're not as, you know, we're not experts at reviewing those types of documents, for example, because yes, whilst we do come across them, we don't come across them as often as we come across other things, right? So for someone who's a lawyer who looks at agreements all day, you know, there are standard words, you know, that are in there. You could just jump over those. You're like, okay, this has to be in every contract. Those aren't things we're necessarily aware of. We do have a certain level of legal training that's part of our accounting qualification, but it's nothing as in depth as obviously your training is. So, you know, there are agreements we look at. But we would potentially also consult someone in our in-house legal department to say, okay, can you take a look at this? You just know a lot better what you're talking about here than, you know, me looking at this.
And a lot of times we do rely on management's representation. So as Patricia said earlier, I think, you know, if there's something, we won't know unless someone tells us about it. So at the end of every audit, we'll have management sign a letter essentially saying, we've told you everything we know about, right? So that there's hopefully no way that there's something that they didn't tell us about that could potentially come back and cause a problem for us as well. I mean, you know, everyone tries to cover their butts a little bit, and it's, you know, we have to mitigate our risk as well.
Cool, thanks for that.
Great, thanks for asking the question.
Okay, and that kind of follows actually a question that was asked earlier on, which was, I guess, in a similar way. You mentioned fraud earlier on and how you wouldn't really be auditing for fraud specifically, but who then is responsible for the fraud, for like identifying the fraud? And is it similar to what you've just said to Jawad? Is it a similar kind of thing in that you do a cursory overview, and if something's glaringly obvious, you point it out, or is it you just blast it on?
So we take, it's management's responsibility to identify fraud. So that's why companies have controls in place, you know, like for example, let's say for the payroll department, the same person that approves your payroll should never be the same person that pays your payroll, right? Because otherwise they could just put some fictitious employees on there, put their bank details into those, you know, non-existent employees and just pay themselves. So, you know, they should have controls in place to avoid for that happening. Sometimes there's a lack of controls, which means there's a higher risk of fraud. So what we as auditors do is before we even start an audit, we generally assess different risk levels for different areas, which means if, for example, we've looked at the company and we think, you know, there's a high risk, for example, for them to overstate the money that they've earned in the year, because there are certain controls that are not in place, or, you know, payroll. Let's say there was an incident in the previous year where, you know, there was a fake employee created. So those are areas where we're like, okay, high risk. So what we can do, the only thing we can do is give it a high risk level, and a high risk level automatically means more testing. So if we usually would only look at, you know, 30 employees, because we've given this a high risk level now, we're looking at 50 employees as an example, for example. And that's how, you know, from our side, we can say, okay, we have reduce this risk to an acceptable level because we've increased our testing by a certain amount, because we see this is an area where there's risk. But that still means, you know, that, you know, if there are mistakes, they might not be in those 50 little things that we look at, right? They might be in something else, and then there's nothing we can do. So we again get them to sign something to say, you know, we take responsibility for fraud in the company.
We have a responsibility to report. So if we found anything that looked like at all strange, like that's something you've got to keep juniors in check of sometimes, because everything looks like fraud. But if there's something that is legitimate, and we're like, don't email me if you think you've found the tiniest fraud, that is probably not a fraud. But if we do find something that is indicative of fraud that we think could possibly be, it's our responsibility to report that to management and those and directors. We have to kind of report it further up the chain until we're satisfied that, you know, someone who can do something about it will know about it. So, so it's our responsibility to report on it. And for example, as Patricia said, if there were a lack of controls, we also provide that information to, you know, the directors as well. So if we said, oh, look, you know, you don't have a second signatory on your checks, or there's a lack of segregation of duties here, we would put that in our report so that they know and can fix it.
They usually don't.
Point.
Right.
And also, I guess you don't have to sign off on the report. If you're really not satisfied, you don't sign the report and hand it off at that point as well.
Exactly. It basically almost never happens, but yes, if it would get to a level where we say, look, we don't feel comfortable, then, you know, and the problem is also at level is the fraud, right? Because the level it could be at management level. So for example, if management receive their bonus based on how well the company is doing to us, we're like, okay, there's a risk, right? Because if they're doing better, they're receiving more money, which means, you know, there is incentive to pretend like the company is doing better than it is. And, you know, if obviously we, for example, detect fraud and it's at management level, then who do we report to? There's no one higher, right? So we also need to be careful with like not, you know, tipping someone off. If we tip them off and then they go running with the money, that'd be not so great. So within each accounting firm, there's someone called, you know, like a money laundering officer or something like that, who we then report to, and then they kick in the official, you know, steps with, you know, informing the police, the relevant departments and all of that, to deal with that.
Okay, hopefully that answered the fraud question that was asked earlier on.
Right. I also want to just sort of jump in very briefly. I think there is also a separate sort of service that law firms provide called a legal audit. You know, those sorts of services, I've been involved in a couple, and they sort of screen the agreements and their performance and all the sort of documents that have gone in the performance of those contracts to see whether everything is in order, and they identify the legal risks and the risks of, you know, like a fiduciary duty being sort of breached in those circumstances. So yeah, maybe that's something that there can be many kinds of audits. That's what I wanted to say.
Absolutely, definitely. Juan, you've been waiting very patiently.
Thank you. Thanks, Patricia and Sarah. This was a great presentation. I'm a Mexican tax lawyer, so I know a little bit about this. I sit in practice, but I wanted to ask you, in BDO Canada, have you seen something completely different from back home, that it's very Canadian related only, you know, like something in the practice that is completely different from the rest of the world?
Well, I mean, we can't speak for the rest of the world, but I think we can speak for a few countries. I, for example, before I came here, obviously have never dealt with the Canadian auditing standards. I've only really primarily dealt with the IFRS, which we said earlier, you know, has a bit of a high level of scrutiny. So a bit of a change for me was, you know, dealing with, for example, ASPE, and, you know, having to just scale it back a little, not having to go into as much detail as I'm used to. But other than that, I don't think I've come across anything major. I don't know, have you?
What's different here, I think, compared to New Zealand and Australia, is that we audit a lot of government organisations here, where in New Zealand or Australia, there'll be a separate government organisation that will audit the government. So I have audited, you know, quite a few municipalities, like health organisations, where we're at home, like the Auditor General of New Zealand and his office will audit those kinds of entities. But essentially, I think something that we noticed here is that there is no real legal obligation for all companies of a certain size to be audited. So in New Zealand or Australia, for example, your company earns over $20 million of revenue or has over $10 million of assets, you're required by law to get an audit. And I think generally it is for tax purposes, you know, that, and you have to submit those financial statements, whereas in Canada, you don't need to. So it's kind of, it's a less burdensome. Yeah.
And that makes also the fees lower, because there is no requirement. So it's a lot less companies that need to get audited because of the lack of that requirement, because it'll only be, unless you're listed basically and your shareholders or your bank want it, you don't really need it. So whilst if they're in the UK, for example, same as in Australia, they have to get audited over that certain size, you know, we can automatically request more money because we know they have to. Not that we would never ever, I mean, anyone. But there's more competition, right? And that kind of like just leads to the whole.
Yeah.
Absolutely, absolutely. Hopefully one that helps.
Sorry?
Hopefully that answers your question.
Yes, thank you very much.
No,
Janet.
That was actually the same question I was going to ask, so thanks, Juan.
Look at that, you guys are on the same wavelength. That's perfect. Sarah, do you want to ask your question?
Great name.
Sure. Thank you so much, Patricia and Sarah. So I was wondering, like, over the years, what has been your best experience working with lawyers? Like, do you have one?
My best experience working with lawyers has been going to the pub afterwards and having a pint.
Okay, that's fine with me. Fine.
When you can stop talking business and you can start enjoying life. I mean, I've not had to deal that much with lawyers other than, you know, getting confirmations, and, you know, the best ones are the ones. Actually, just a couple of weeks ago, I had to close off an audit, and sort of during the audit, we request, you know, the confirmation whether there have been any, you know, any legal issues, any outstanding claims. And then towards the end, just before we put that signature on, we just confirm one last time anything new that has come in. And this lady, she got back to me within the day, and I was like, that's great, thanks, I'm loving this.
Those are our favorite lawyers.
If you respond quickly, we'll love you. It's just when there's a time pressure, right? Like, and we understand everyone has a lot of work to do, and, you know, we're not their biggest priority because, you know, we're not even their client. But sometimes, you know, there is a bit of a quick turnaround, and, you know, most of the time, you know, you can anticipate that, but sometimes you can't, and then it's great to hear that.
Yeah, I mean, normally the time when we're talking to lawyers is billable time. So, you know, lawyers are always happy to help us. You know, I think I haven't had a bad experience with a lawyer.
Okay, thank you.
Yeah, I can imagine though the most stressful time would actually be when you have to audit a law firm in particular, and especially if that law firm is a mess, which can happen. And when law firms get audited, they're not done annually. Here in Canada, they are spot checked, so they are literally picked at random. My law firm got audited 2 years on the run, and by the 2nd year you'd think we'd have it down, but we were still a nightmare to our poor auditors who came in. We were still scrambling because as Patricia and Sarah were saying earlier, they just pick certain bits and do sort of, you know, if you've got 200 employees, they'll just pick 30 employees to audit. Similar, when they audit a law firm, they will just randomly, they'll ask you for a list of all of the files that you're working on, and they will just randomly pick a bunch. And you're praying they're not going to pick that one file that just is a gong show, right? But you know that that's the file.
That's exactly what happens. Like every single time, there's always that one, and you're like, oh my God, why did I have to pick that one?
Yeah, and it's normally the one that, you know, somebody picked up all the files and literally dropped them on the floor, and then they just shoved them all in a box, hoping that we'd never have to look at it again. And that's always the file the auditor wants to look at. So that's kind of like a little heads up for you guys. Try and do your like document management as you're going, as it's ongoing, because you never know which file you're going to get audits done at some point in your career. And it just makes it so much easier for everybody involved if you've got a nice clean file that's nice and tidied up and in sections. So if you haven't, go and watch the video all about like our file management session that was done earlier this summer, because that's really, really useful.
It's like we're little truffle pigs. We'll find the truffle. We'll find where the issues are. Honestly, every single time. It's
I know, you just want the one thing that's going to have no issues, and you don't even choose.
We don't want the one. We don't want to find issues.
We don't even specifically choose. If it's random, we'll pick it'll be a sample calculator. It'll just be random. It's not even our fault that we're being awful to you. It's just bad luck.
Yeah, it's all good. You know, they give you a little bit of a heads up. You have like 5 days or a week or something, because sometimes you have to pull all those files from storage because they're not physically on site.
Yeah.
You have time that you spend, you know, a night with your assistant sitting there organizing it all, so it's logical, so it makes sense for people. So you do have time to get it back into order on that one. I don't know the answer to that question, whether we've been doing audits during COVID. I definitely haven't heard from them. So hopefully we're not getting audited again this year. Fingers crossed.
We're doing audits during COVID.
Yeah.
You want an audit done? Let us know.
Yeah, I don't know what the deal is with that this year. I'm sure they are doing it, but I'm sure, like Patricia and Sarah said earlier, they're probably doing it virtually rather than in person. So it probably looks a little bit different this year.
You're gonna have to do a lot of scanning.
Yeah.
Yeah. Fortunately, mine is all electronic. So it's made my life a lot easier this year. But for those law firms where everything is still quite heavily paper-based, even when the auditors and the accountants are requesting documentation, if it's all paper-based, it's very time intensive because it all has to be either scanned or copied, and then a courier has to deliver it, and then it has to be reviewed in person. So if you can keep things electronically, if that's possible in your practice, it does speed the process up for everybody. And I know I'm notoriously bad for responding late, so I know my auditors get really annoyed. They have to send me reminders.
Okay, we'll forgive you.
Yeah, absolutely. Absolutely. Does anybody else have any last burning questions, or did you ask a question earlier on that I missed during the chat? Now is your time. Otherwise, I'm going to let everybody go. I'm going to thank Patricia and Sarah very, very much for joining us. Thank you for blowing our minds with all of these numbers and calculations, and I'm sure everybody is going to pull out these slides in the future and use them and reference them. Again, I will send an email around everybody. It will include Patricia and Sarah's contact details, but I do ask though that this is a really busy time. They are about to go into end of year audit season hell very shortly. So do send your questions to me at glcbc@glcanada.org. I'm going to compile all of those follow-up questions, send them across to them, and then we're going to do the answers in some format. We'll figure out what the best format is to do with that. Patricia, Sarah, thank you so much for giving us your time this evening. Really, really appreciate it. Good luck with audit season. Hopefully this year is not quite so chaotic. Fingers crossed. No, this year
one can only hope, right?
Yeah, thanks, guys.
absolutely. I mean, hopefully though this year, because we all got the extensions, everybody's like a little bit staggered now, so it won't be quite such a mad panic when we get to December 31st and the next 4 months after that for you. Everybody, hopefully you can join us next week. We do have 2 sessions next week as well, so make sure you check the email I'll be sending. It will give you the registration details for those sessions, the times, because they're all at different times, so make sure you put them in your calendar because they're not at the usual 5 o'clock time either. But they are sessions I think you're all going to want to do if you can fit them in between your exams, because I know many of you are in exam season. For those of you who are writing exams, we all have our fingers crossed for you. You guys are going to be great. Just take a deep breath and you'll be fine. Have a fantastic rest of your week, everybody, and we'll see you all soon. And thank you again, ladies.
Yeah, thanks everyone for joining. We had a really good time and it's lovely to meet you all. Have a great evening and see you at some point in the future. Hopefully for a pint instead of an audit.
Oh, so nice.
Yeah.
Bye.
Bye, everyone.